Hello, guys. I hope everyone is doing fine. Today, I think I can take a short session on options, what options are, and what are the different strategies using options that we can do in the market. I think some of the option strategies are very safe with minimal risk or defined risk that we can use to consistently generate income. A few of these strategies are risky. So, let me start. Options are the derivative instruments. A derivative is an instrument, if you ask me, the value of which is defined by the underlying, right? So let's say you have an option contract on Microsoft. The value of that option partly is derived by the price of the stock of Microsoft in the market, right? So if the Microsoft price goes up, the options value increases. If the value goes down, it decreases if it is a call option, or vice versa for a put option, where the market value of the put option increases if the stock goes down, and if the stock goes up, it decreases, right? So there are two kinds of options. There are calls and there are puts. Somebody who thinks that the stock is going to go up, he will purchase calls or he will be long calls. Bears who think that the stock is going to go down, they purchase puts. Now it is in the anticipation of the price going up or down, they usually do these strategies, right? As we are discussing. Now, if you want to have a quick look at the option chain, I've explained it before. So for every stock, if it is uh, having options, right? Not all the stocks have options, a few of them, but if the stock is having options, you will see the option chain for that stock, and you will see for a particular expiry, they have weekly expiries. So if you see 13, 20, 27 like that, so stocks usually have weekly expiries, whereas index options have daily expiry like SPY and SPX. If you look at here, you see all the calls on the left side and all the puts on the right side, which means that all the bulls who think the price is going to go up are focusing here on the left, which is calls to go long. And all the bears who think the price is going to go down, they are focusing to go long here on the put side, right? A few things to note: at the money calls and puts, which means that the option is strike. If you see, every option has an strike, so they have different strike prices compared to the stock price. So whatever the strike price is there, which is closest to the stock price right now, that is called as at the money option. So at the money option for calls and puts, if you see the premiums for these, the bid and ask prices, which means if I want to buy a call option, I have to pay 273. If I want to sell a call option, I receive 225. Similarly, for puts, if I want to buy a put is 113 bucks, and if I want to sell a put, it is 105 bucks, right? That is what the range is for bid and ask. In addition to that, you can see the open interest and volume. As I have explained before, open interest is the total number of contracts open as of that trading day, and the volume is the total number of contracts which exchanged hands. You can say the number of contracts exchanging hands between people. So how do you know where the stock price is going to go? You can identify that. So the first is sum up the premiums of the calls and puts. So here, if the calls are trading at 273 and puts at 113, so I would say somewhere around 3.8 or 4 bucks, which you can also see here is the movement of the stock up or down, which means that the sum of the premiums of the calls and puts which are at the money options, it is equal to the range that is defined for that stock to go up or go down. So I can expect Microsoft to go up by 4 or to go down by 4 bucks by tomorrow, which is 13th of October, which is the expiry date for this contract, right? Now, how options were introduced initially were for hedging purposes. If you do not know, uh, retail traders came in after and they started buying and selling contracts in the anticipation of making money, or by trading some speculative strategies on options. But initially, big funds, hedge funds, mutual funds, or institutions who are holding money uh, or who are managing a big portfolio, they would hedge the risk of the price of the stock going down by purchasing put options, right? So ideally, if I am long 100 shares of Microsoft at 331.16, if in case if I think that market might go down because of certain issues, because of the economy going down, inflation increasing, or if I see some risk, I want to hedge myself or protect myself. But I also don't want to get rid of the stock because I think Microsoft is a good company fundamentally. It is very strong and in the long run, it will benefit me. So what I'm going to do is instead of selling the stock, 100 stock, I will buy one put contract, which is uh, around the same strike. So let's say I get into a 330 put for Microsoft for a longer time horizon, not for October. So if I'm willing to hold the long 100 shares of Microsoft until January 2024, which is 99 days from now, I would purchase a 330 put for Microsoft at 14.95 or 15, right? Which means that irrespective of wherever the price of the Microsoft is within the next 99 days, I am having the right of selling my stock, the 100 shares at 330. Now, what is the breakout or break even for this? In that sense, if you want to see, I will only make profit if and only if the price of the stock goes down by 330 minus the price I paid, which is 15 bucks. So in case if the price of the Microsoft lands up below 315 by January 24, I will be in profit because that is my break even point at that point in time. So if the price of the stock keeps sliding, I will keep making money as long as the price of the stock uh, is below 315 by January 2020, 19th, 2024, right? That is the idea. Now, how do I benefit from this? The benefit of buying a put option is I am covered, which means that whatever happens to this company or due to the economy, if the price goes down, I am hedging myself, so I am still able to protect my profits. I will not be in a loss. At max, I will be losing 1500 bucks, but I will be able to close the position at the 330 stock price. So the max loss is 15 or 1600 bucks. But in the meanwhile, if the price goes up, I can sell this stock. If the price comes down, I can buy it back. So I can make profits in the interim through January 19, 2024, and I can cover some of this cost of the put. Now, another way to reduce the hedging cost, this is called as hedging the position. So another way of reducing the cost of buying the put is you can sell a call out of the money. So if I think, okay, it's not going to go up above 375, uh, which is the price, I am expecting it, the price of the Microsoft to be below 375 by January 19, 2024. I will sell this out of the money call, let's say for 4 bucks. So I'm reducing the price of buying the put by 4 bucks. So 15 minus 4 is 1100. Now my max risk is 11 bucks, provided the price of the stock doesn't go above 375 and it goes below 315. I mean, it's one or the other condition, right? So in that way, which is this is a strategy where I'm also hedging the risk of stock price going down. I'm also covering some of that cost by selling out of the money put, right? This is one of the strategies that most of the portfolio managers would use uh, because they are holding stocks. Now, alternative to that, if you do not want to buy 100 stocks for Microsoft, it might cost you 33,116 bucks. What you could do is buy an at the money call. It is the same. So if you see the impact of buying 100 shares at 331 or either or the impact of buying one contract at 330 at the money call at 330, it is the same because ultimately they give you the same profit. Now the benefit of holding a stock is you get dividends, and maybe in the interim, if you want to buy and sell the shares because you are already covered with the put, you can do that. Or there are some other benefits. If you hold the stock long run, you don't want to sell it, you think it is going to go up, it is a good company, you are having a stock. What are the disadvantages of holding a long position on put? The value of the put decreases because there is also a time factor or time decay. So as you approach closer to the expiry date of the option, the value of that option, whatever the cost that you was incurred in buying that, the 15 bucks, if the stock doesn't go too much up or down and stays around the same strike, you are going to lose money on that premium, because there is also a time decay on the value of the option. Any option which is expiring less than 21 days will significantly start losing value if it is a long call or long put option. So that is one of the drawback of an option. And the second drawback is, if you're buying options, there is a time decay value and options have an expiry date. So if it doesn't work out in your favor, you are going to lose the whole premium what you paid in buying the long call or long put, versus a stock which you can hold in the account irrespective of the price movement of the stock in the long run. If it is going to go in your favor, you can benefit, right? Now, other strategies that we can go with options is selling. Now, selling the options or calls or puts is risky. If you do not have a position, you should not ideally go ahead and sell calls or puts, because these are considered very risky strategies. So, what does it mean? So, if you want to sell a call, it is a bearish strategy. And if you think Microsoft is 331 today, and by January 19th, 2024, it is not going to go above 400. If you are predicting that, if you are a bear, if that is your mindset and trading strategy, you will sell this call of 400 strike for Jan 19, 2024 of Microsoft stock at 1.38 bucks, which means you are considering a bearish strategy. You think that the price of the stock of Microsoft will be below 400 as of Jan 19, 2024. So whatever you are selling here is the premium that you will keep if the option expires worthless, which means that the underlying stock price stays below 400, right? That is what is called as selling an option. It could be risky, because if something happens and Microsoft goes above 400, let's say if it goes to 500 by January 19, 2024, you will have to sell short the stock uh, at that strike. So even if the price in the market is 500, you have to sell it at 400, which means that you are incurring a loss of 100 bucks per contract, 10,000 loss like that. So ideally, you should not be doing it. I mean, you should only be selling calls if you are long the stock, because in that case, you can sell the stock worst case if it is in the money, right? So similar to that, we have selling the puts. Selling a put means when you are expecting that the stock is not going to go below certain price. So let's say if Microsoft is trading at 331.16, and if I think it is not going to go below 250 by Jan 19, if I am a bull, so I will sell this put at 250 strike at 109 or 1.1, which is 110 bucks, provided the stock price of Microsoft doesn't go below 250 by Jan 19, 2024. I will keep the premium and it will expire worthless. Now, in case if the price goes below 250, if something happens, I have to buy Microsoft at 250 less the premium received. So in that case, let's say if the price of the Microsoft goes to 200, so at on January 19, 2024, if it is trading at 200, somebody in the market can go get and buy it at 200. But because I sold the put at 250, I am now obliged to buy 100 shares at 250 less the premium I received. So 249 something. So in that case, I am making a loss of 5,000 bucks on 100 shares, if you know what I'm talking about. So that is called as selling the puts. Selling puts is the riskiest strategy, because not applicable for Microsoft, but there is some company where people are speculating if it is a new company, and if it goes down for some reason, goes to bankruptcy and something happens, the stock price goes to zero, you are still going to purchase the shares at that committed price if you are selling the put, which is the most riskiest strategy, right? Now, what alternatively you could do is you could do spreads, which means that you are covered and you have a limited or defined risk. So instead of selling the 250 put, you could sell the 250 and buy the 245. You could do sell a vertical, which is called as a vertical bull put spread, where you are receiving 18 or 20 cents. I know it is very less, but you are covered at max. You will be at a loss of 500 versus 5,000 we saw. And similarly, if you are selling a call, you can do a vertical call spread, which is a bearish strategy. Instead of selling the 375, you could sell 380 and buy 375. a vertical beer call spread where you are receiving 60 cents, but all you are covered. The max loss is 440 bucks here in this case because it is a 5 wide strike, right? So these are some of the strategies which we can use. Now, if your account size is very small, and if you cannot do these strategies, cannot buy the stocks, cannot just buy the long calls and options, I always suggest you do sell uh, vertical call is beer spreads because that is the most effective in my opinion to profit right now. However, the situation is, and we are still waiting for another meeting with Fed, and nobody knows if they are going to raise the interest rate again and where the markets are going to be. And there are talks about us going into recession, mild recession next year. Q2 or Q3, no one knows, right? So the market is not going to go up right now. I think it will be in certain range until unless everything works in favor of market, it is not going to shoot up. So what we could do is sell out of the money calls for a few of these stocks or indexes uh, that could benefit us, right? So and that we can do on weeklies. So you could also do that on the 0 day to expiry. Maybe if you want to know what a 0 day to expiry is, the options expiring the same day. So the 13th of October tomorrow will be 0 DTE because it will be expiring tomorrow. And here, if you get some idea from the options flow, or if you can get some hint, looking at the trading strategies, looking at the moving averages or charts, you can sell these vertical calls out of the money. You can receive some credits if the price closes below uh, these strikes, and if it works out in your favor, you keep the premium. The positions will expire worthless. You won't even hit a day trade. So some of these strategies you can do in your account. If you are a small account holder where you have just 5 to 10,000 bucks in your account and you still want to make at least a few $100 every week, it matters, right? So that was it around the option strategies. There are a few other strategies. I would take the session later. Like we have iron butterflies, we have iron condors, where we have the defined risk, where we have the maximum chance of winning, right, or profiting. So I will come back with another session. In the meanwhile, enjoy your time, subscribe to my channel, and if you have any questions, please comment so I can answer. And if you want to comment on any other area where I can take some sessions or share my knowledge, I would be glad to do that. So thank you so much. Take care.